Hello, and welcome back to Forex School from Pip Insight. This is the complete swing trading course, the patient framework for people who want to trade properly without living at their screens. Here's the roadmap. First, we'll define swing trading, holds measured in days to weeks, and why that rhythm suits anyone with a full-time job. Then we'll build the Sunday routine, the weekly chart for bias, the daily for the level, the 4-hour for the trigger, a top-down process you can repeat every single week. From there, how to pick a level worth waiting at, the 2 entry triggers, stops and targets in swing terms with the asymmetry rule, and how to manage a trade that runs for a fortnight. We finish with the honest chapter, weekend risk, swap costs, and the months where nothing works, then a full recap. Kettle on, notebook out, and let's begin. Let's start with a proper definition, because swing trading is less about what you trade, and much more about the rhythm you trade it at. Days, not minutes. Structure, not noise. Swing trading sits between day trading and investing. A swing trader tries to capture one swing of the market, the move from one structure point to the next, and holding that move takes days, sometimes weeks. The working charts are the weekly, the daily and the 4-hour. The 1-minute chart simply doesn't exist in this framework. That changes everything downstream. A handful of trades a month is completely normal. Decisions are made slowly, in calm, usually at the weekend, and executed once. If day trading is a sprint decided in seconds, swing trading is chess by post, slower, quieter, and far more forgiving of a busy life. And that is exactly why it suits people with jobs. The whole method needs one proper planning session a week and a few minutes after each daily close, no screen watching between meetings, no panic at your desk at 2 in the afternoon. Wide, structure-based stops mean the intraday noise you never even see can churn away harmlessly while you work. Fewer decisions also means fewer emotional mistakes. Most trading damage is done by fast fingers, and swing trading takes the fast fingers out of the equation entirely. The market does the waiting for you. Your job is to plan well, place the order, and then, genuinely, leave it alone. So how do you actually plan a swing trade? With a routine you can run every single Sunday afternoon, in under an hour, in the same order every time. 3 timeframes, 3 questions. The routine is top-down, and each timeframe answers exactly one question. The weekly chart, W1, sets the bias. Which way is the tide flowing? Higher highs and higher lows mean you're only interested in buying, the mirror means selling. The daily chart, D1, finds the level. If price pulls back, where is the structure it should land on? Market, set an alert, close the laptop. The 4-hour, H for X applies the trigger, but only later, and only if price actually reaches your level. Bias, level, trigger, in that order, every week. And if any one of the 3 is unclear, the routine has a built-in answer, no trade this week. So what makes a level worth waiting at? 2 ingredients, ideally stacked. First, prior structure, a swing high or low the daily chart has already respected, or a broken resistance that should now behave as support, levels with memory. Second, round numbers, the 00 prices like 127 exactly, where orders naturally cluster because human beings think in round figures. When a structural level and a round number sit within a few pips of each other, that's a swing level. And a quiet rule of thumb, the best levels are obvious at a glance. If you have to squint to justify it, it isn't one. Every candle here is one full day, so you're looking at nearly 3 weeks of market. Price climbs into 127, a round number, and stalls just 2 pips above it. Sellers defend the figure for a couple of days. But the dip stays shallow, and then a wide bullish candle closes at 127.20, a clean break of structure, tag BOS. The impulse runs onto 127.86, and then comes the part swing traders actually wait for, 3 red days drifting back towards the broken level. Watch where the slide stops. 126.98, a whisker under the figure. Old ceiling, new floor, round number, 3 reasons stacked at 1 price, and the arrow marks the day the level held. Now the trigger, the 4-hour chart's job. A trigger is simply proof that your level is being defended, and there are two shapes worth trusting. Shape 1, the rejection, price wicks through the level and closes back on the right side with conviction. Shape 2, the break and retest, price closes through a level, returns to touch it from the other side, and holds. Both share one non-negotiable feature: they happen at the level. An entry in the middle of nowhere, with no structure beneath it, is a donation. And if the trigger never comes? Missing a trade costs nothing. Chasing one costs money. Back to our chart, but now watch it the way you'd actually live it. Sunday's plan said, if price pulls back to 127, look for a trigger. The alert fires midweek. The touch candle dips to 126.98 and closes back at 127.08, buyers leaning in, but not yet proof. The next day delivers it, a brief wick down to 127.02, then a drive to close at 127.38. A full-bodied rejection candle, sitting directly on the level, that's the trigger, marked with the arrow. Notice what you never did: you never bought the middle of the pullback, and you never predicted. The level spoke first, the entry answered. Here's the second trigger shape, on a 4-hour chart. The ceiling sits at 128.40, tested up to 128.42, then again to 128.38. Defended twice, so the level is real. Then the breakout, a strong candle closes at 128.60, clean above the ceiling, the break of structure sweeps in, marked BOS. A swing trader does not chase that candle. Instead, patience, price eases back and touches 128.36, the old ceiling, retested from above, marked retest. It holds. The trigger candle closes at 128.74, and from there the market runs all the way to 129.34. Same principle as the rejection, the level proved itself before the trade existed. Stops and targets, swing style. The stop does not come from a pip count or a feeling, it goes beyond the structure that makes the idea valid, below the swing low that defines your level, plus a buffer for spread and wicks. If price gets there, the idea was wrong, and you want to be gone. The target is just as unglamorous, the next structure in the way, the next old high or low where the market has previously turned. Then the filter that does most of the work, the asymmetry rule. Measure reward against risk, and if it's under 2-to-1, skip the trade entirely. At 2-to-1, a single winner pays for 2 honest losers, and that arithmetic is the whole business model. Let's price a full plan on the chart. The level is the broken structure at 127, the trigger prints, and the entry line sits at 127.05. The structure low beneath is 126.96, so the stop zone goes at 126.55, beyond the level, beyond the wick, buffer included. 50 pips of risk. Overhead, the daily chart's next structure is 128.20, the target zone, 115 pips away. Better than 2-to-1, so the trade qualifies. Now watch it breathe, the day after entry closes back at 127.18, deep in the red. The stop isn't touched, so nothing happens. 5 days later price tags 128.24, into the target zone, and the plan completes without a single decision made mid-flight. So the trade is running, and now comes the hardest part, doing almost nothing. The one legitimate adjustment is moving the stop behind new structure, and only once that structure is confirmed. A new higher low counts only after price breaks the previous high. Until that close prints, a pullback is just a pullback. What about checking the chart every hour? That habit has a price. Every glance is an invitation to meddle, to tighten a stop into the noise, to bank a small profit that was planned as a large one. Swing trades pay by the daily close. One calm look each evening isn't laziness, it's the discipline the whole framework depends on. Here's a runner managed properly. Entry comes from the higher low at 126.12, with the stop tucked beneath at 126.06, the line marked stop 1. Price rallies to 127.12, then pulls back to 126.60. A new higher low? Probably, but not confirmed, so the stop does not move. Confirmation arrives when the market closes at 127.28, above the old high, the BOS sweeping in now. Only then does the stop step up to 126.54, behind proven structure, stop 2. Another pullback holds at 126.86, and the process simply repeats. 2 decisions in a fortnight, both made after a daily close, neither made from fear. Now the chapter most courses skip. Swing trading photographs beautifully in hindsight, so before you fall for the highlight reel, let's talk about what it actually costs. Starting with a loser, walked through in full. This is a reel-shaped loser, start to finish. The daily level is support at 127.60. Price falls into it, wicks down to 127.54, and prints a textbook rejection. The trigger candle closes at 127.94. Entry there. Stop at 127.42, beneath the structure. Target back near 129, the origin of the fall, a shade over 2 to 1. Every box ticked, this trade deserved to be taken. 2 days of follow-through, then the sellers return. The level is tested again, and this time a full daily candle closes at 127.26, through the level, through the stop, gone. 52 pips paid. And look at the aftermath, price keeps falling. The stop wasn't bad luck, it was the framework saying the idea was wrong, cheaply. 3 more costs the highlight reels never show. First, gap risk, swing trades hold overnight and across weekends, and a market can open on Monday a long way from Friday's close, straight through a stop, filling at the worst price. Sensible sizing assumes that will happen occasionally. Second, swap, most brokers charge or pay a small nightly financing fee, and over a 3-week hold those nights add up, sometimes for you, often against. Third, chop, markets spend long stretches trending nowhere, and a structure framework in a structureless market produces a string of small, tedious losers. Months of it can happen. None of this breaks the method, the asymmetry rule exists precisely to survive it. But nobody using this framework should be surprised by it either. Let's gather the whole course into one view. Swing trading captures the move between structure points, held for days to weeks, a rhythm built for people with full-time lives. The routine is top-down and weekly. W1 sets the bias, D1 marks the level, H for supplies the trigger, and if any step is murky, the answer is no trade. Levels are prior structure stacked with round numbers, obvious at a glance or not at all. Entries happen at the level, never in the middle, a rejection or a break and retest. Stops live beyond structure, targets at the next structure, and anything under 2 to 1 gets skipped. Manage by the daily close, trail only behind confirmed structure, and budget honestly for gaps, swap, and the choppy months. And that's the swing trading course complete. You can now run a full Sunday routine, read the weekly bias, mark a daily level worth waiting at, demand a 4-hour trigger, price the stop and target from structure, and skip anything under 2 to 1, then manage the whole trade in one calm look a day. Your homework is a paper version of exactly that. This Sunday, run the routine on 3 pairs and write the plans down, entries untaken. If this course earned it, subscribe and turn on notifications, because the next course builds directly on this framework. And the usual close, because it matters, everything in this series is education, not financial advice. No method is a promise of profit, and trading carries real risk of loss, so practice on a demo first, and for as long as it takes. Thanks for studying with me, and I'll see you in the next one.